Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster, and today is May 12th. The weekly market insights. Fed talk calms volatility for the week. The S&P 500 fell 0.5% this week as declines led by healthcare and communication services outweighed gains paced by industrials. The S&P 500 ended the week at 5,659.91, up 1.6% in May and down 3.8% for the year. Concerns about the Trump administration tariff policies have weighed on the stock market. Those worries were underscored on Wednesday as Federal Chair Jerome Powell, speaking after the central bank's policy setting committee left interest rates steady, said, if large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. A bit of optimism emerged Thursday after the trade deal between the U.S. and the U.K. was announced. On Friday, President Donald Trump indicated in a social media post that an 80% tariff on Chinese imports, which would reflect a cut from 145%, may be under consideration as Chinese and U.S. officials prepare to meet this weekend. Many analysts still consider 80% as a high tariff rate, and no further deals have been announced. So on that note, what I've noticed is this morning, this is Monday, May 12th, by the way, markets responding very favorably to that. The Dow's up 985 points, 987 points or whatever, up 2.4%. The S&P is up 2.62%, trading around the 5,800 range, and the Nasdaq's in the 18,000s. So it's up 3.51%. So you're talking about 2.4 to 3.5% boost across major markets. So the markets definitely like the working deals with China. And so just to review again some of last week, stocks went sideways. So last week, among sectors, healthcare posted the largest drop, falling 4.3%, followed by a 2.4% decline in communication services. Consumer staples, real estate, and materials also declined. So what I noticed about the healthcare space dropping is, the Trump and Bobby Kennedy Jr. signed executive order lowering some drug prices, kind of trying to get some parity with some of these other nations in the pricing of drugs. And so it was kind of like a big hammer to some of the pharmaceutical industries. They kind of sniffed that out, I think, at the end of last week. So Vertex Pharmaceutical shares fell 15%. The company reported Q1 adjusted earnings and revenue that trailed estimates by analysts. At least two analysts downgraded their ratings for the stock. In communication services, Match Group, or Match, as most people know, .com, shares shed 11%. The company plans to cut its workforce by 13%. Among the sector rallies in the week, industrials climbed 1.1%, following a 0.8% gain in consumer discretionary, 0.5% rise in utilities, and 0.4% advance in energy. Technology and financials eked out small increases. Rockwell Automation shares jumped 16% this past week. The company reported fiscal Q2 results that topped Wall Street's projections and raised full-year earnings guidance. Next week's earnings calendar, so we're talking this week as I'm releasing this on Monday, features Cisco, Walmart, Deere, and Applied Materials. Economic data will include the April consumer and producer price indexes, two closely watched inflation readings, April retail sales, industrial production, and housing starts, as well as May's consumer sentiment report are expected this week. So got a busy week. So again, as a recap, weekly market insights, major index returns, Year to date, NASDAQ's down 6.97. Again, that's through the end of last week. But what did I just say? Today was up 3.5%. So I suspect it'll cut into some of that negativity in the NASDAQ return. MSCI EFA index, which tracks developed overseas stock markets, is up year to date, trailing 12.92%. That's that international bid that we've talked about many times on the podcast. S&P 500 is down 3.29%. So we're cutting into that by quite a bit, 2.68% on the day today. So we'll see if that holds. And Dow Industrials, so Dow Jones, down 2.27% on the year. So not bad. I mean, still over the 1 year trailing, 5 year trailing numbers, substantially green across the board for major indexes. The 10-year Treasury note's trading at 4.37, and that's up a bit from the 4.34 that we had just a month ago. 3 months ago, we we're trading at 4.51, so it's still down from that, and then 4.45 still down from a year ago of where the 10-year Treasury note's been trading. So thank you, YChart. Data as of May 10th, and thank you for producing an amazing platform for analytics, charting, and reading data. Also to Stock Charts, well done with a lot of the charting stuff that I look at. The Fed fans out. So the Federal Reserve wanted to get its message out last week. Within 48 hours of the Fed's decision to leave interest rates unchanged, nearly every Fed governor gave a solo speech or discussed the decision on a panel. One Fed official spoke about the benefits of long-term stability from an independent Fed. At the same time, another said the Fed was paying close attention to what consumers did and not just what they said, suggesting that flagging consumer sentiment didn't necessarily mean a slowdown in spending. It just means people aren't as happy, right? So the Fed seemed to focus on managing expectations. Perhaps more importantly, Fed officials spoke from a coordinated playbook, possibly designed to help settle financial markets, which, by the way, is one of their mandates. So when you have a bunch of Fed heads out there talking their book or talking different things, that's not healthy either. And so at least they've gotten together and they're deciding to kind of have a coordinated approach into their messaging, because that plays a big part in our very quickly advancing technological world, in the world of AI now, the world of instant news, by a social media tweet or appearance on a major platform. All right, so let's go to the tax tip of the week. Don't forget to take advantage of the Work Opportunity Tax Credit. If you don't know what that is, the Work Opportunity Tax Credit is a federal tax credit for business owners who have hired individuals from target groups that would have otherwise faced significant barriers when looking for a job. Some target groups include summer youth employees, those receiving supplemental Social Security income, or qualified long-term unemployment recipients. There are 10 targeted groups in total. The Work Opportunity Tax Credit equals 40% of up to $6,000 in wages paid or incurred, with a maximum credit of $2,400. The WOTC may consider up to $24,000 in wages for certain qualified veteran target groups. The restrictions are on the IRS website if you want to check those out. And again, this information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. We got a good show for you. Hey everyone, this is Brent Foster. So check this out. The market is rallying. It's up like 3% today. The S&P, that is. The NASDAQ's up 4% today. And the Dow is up 2.62%. It just keeps grinding higher. I mean, I'm recording this like midday because I wanted to see where things are at and then report back to you. But it's pretty substantial, the trade tension pressure relieving and the more clarity and certainty coming back to the market and sentiment pivoting. It's pretty interesting. It's pivoting. And it is substantial. So I thought, well, let's do a technical analysis spotlight. Let's take a look at it. And man, okay, so we're trading at 58.33. At the beginning of April, we were at just above 4,800, right around 4,800. Think about that. That's 1,000 points from the beginning of April, and this is May 12th. 1,000-point rip all the way back up past the 5,700, 5,800 level where we gapped down. Okay, so we literally lost 1,000 points and gained another 1,000 points back in what it looks like ABC correction. And we'll see if this is a perma bear market impulse rally. This is a massive head fake, but I actually don't think it is. And that's important to note. We are in a long-term super cycle bull market. And man, the market, like I said before, when Trump came out on Liberation Day, literally just shot a bazooka, didn't aim, didn't ask question, just shot a bazooka, said, we're out, we're done. Sells off from 61.44 on February 19th in the S&P. It took a pause around 5,500, did a little head fake rally to 5,800 and then gapped down to 4,800. And all of that has been recouped. So we're actually, incredibly back to 58.34. And this is why you stay disciplined in your investment strategy. This is why you have high quality investments or holdings within a portfolio. You can definitely make adjustments as information and new data comes out, information changes. You can make adjustments. But to sell out, go to cash, you have to make a couple of decisions. One, the decision to get out. Then subsequently, if you're actually an investor and you're going to invest over the long term, is figure out a way to get back into the market. And that's the most challenging part. Now, the people that sold out earlier, let's say around 5,500, 5,800, say they went to cash and then it gapped down, you feel like, oh yeah, look at this. I totally missed that 1,000-point drop. And then you didn't get back in. Boy, that stinks. Stinks right now. Why? Because the market's trading higher than it was when you sold out. So what do? Do you chase? Do you get back in? It's really difficult to time markets because of that, because if you're talking to an advisor who says, hey, now's a really good time to get in, and it's 4,800 after the market's down a lot, well, we don't know what Trump's going to say or do. We don't know what the Fed's going to do. We don't know what China's going to do. We don't know what's going to go on. Well, this is a good time based on, and then you list off all the reasons why as to deploy capital back into the market at a lower price point, and then the market rips and it's at a higher point now than it was when you got out. So now that would be really interesting to see what propels the equity market or the S&P 500 from where we're trading it today at 58.37 up to 61.44. What does it take to get there? Are we essentially going to get back up to that 61.44 area and then fail it? Or are we going to actually have a catalyst that pushes us higher above 61.44 to say 6,200, 6,300, 6,700, maybe even 7,000? All the economists out there that lowered their year-end price targets, who are all betting on a recession in the back half of the year, and we could possibly get one. Maybe that was already priced in at one point, fleshed out a lot of the people that were over their skis or didn't have the stamina to stick with it. We'll see what happens. It'll be interesting to see where things go. Now, not to say we couldn't have some very, very terrible news that could cause a retesting of the 4,800 lows. There's no doubt about it. I mean, there's a chance that that could happen. So people have to be mindful of the risks they take, their portfolio diversification, how they're allocated across asset classes, across sectors and industries, across market caps. How much cash do they hold? I mean, not bad when cash is currently paying 4%, let's say. So you could park it in cash, kind of wait and see. But not going to zero, not going to the cash that pays you nothing, or um, leaving money in a bank account at a bank that pays you like 0.01 or 0.5, where you could be getting 4 or 3, 3.5, 4. I mean, inflation is below 3 at this point. Um, what if now is just a time to tactically adjust, make an adjustment instead of 70-30, maybe you go 60-40. This is a great gift or great opportunity to make adjustments to portfolios, maybe reducing risk in anticipation of what might come if things get worse, or maybe it's actually a better time to reassess where you're at financially. What do your personal cash flows look like? What does your net worth look like? What are your goals and objectives? What are you trying to achieve in the next year, 2 years, 3 years, 5 years, 10 years? Maybe even longer than that. Maybe it's 15 or 20 for you, or 30 years out. If you have a longer time horizon, I mean, markets are trading down relative to where they were in the past. If you have a shorter time horizon, maybe consider raising some cash at this point. You've been given a relief rally that can give you an opportunity to readjust your portfolios and expectations, and maybe provide the cash flow that you need, or a little more stability to your portfolio. Maybe something like that. And so now is a really good time over the coming couple of months, over the summer here, to figure out where you're at, what you want to do, what you want to achieve and accomplish, your goals, your objectives, the risk you want to take. Now's a good time to do that. So I wanted to provide some market commentary and thoughts. It's pretty interesting how quickly markets can correct and how quickly they can rebound in this day and age, with AI, with trading, with settlements speeding up that process big time. That's fundamental market dynamics, that everything is getting quicker and quicker and quicker and faster and faster and faster. So it's not slowing down. It's not like going the other way. It's actually speeding up. And so I think it's more important now than in the past to work with somebody who has experience, understands the markets, can help you stay in the market, diversified to a degree, not over diversified for the sake of diversification, because that is ridiculous. Also, liquid. There's this big push out there by wealth management companies to talk about alternative assets. I've got some things to say about alternative assets. They're not bad for the right people if you have enough money to withstand a substantial loss, because alternative assets are typically less transparent, have longer holding periods, and you're not really sure when you'll be able to redeem those investments. So liquidity is a big deal. How do they mark accounting? Are they completely transparent with what it is that they actually own? And how are they communicating that transparency? So there's a lot of lessons people can learn as there's this domestication push of private markets to the general population en masse. I would warn a lot of people to really think long and hard about those types of investments in your portfolio when the equity markets have been working and do continue to work over time. And the public markets tend to be a bit more transparent and will do a lot of due diligence for you. Okay. All right. So that being said, This is an interesting setup heading into this week. We'll see how tomorrow's trade goes. We'll see what Bassett says. We'll see what Donald Trump and the administration say about trade war, tariffs, and all the like. Maybe we get the extension of the Tax Cuts and Jobs Act coming up, as well as additional benefits on the tax front. We'll see how that goes. That might be tailwinds to help us avoid a major slowdown in the second half of this year. I don't think it will be as bad as what the news media has been talking about. So try not to pay attention to a lot of the people talking on the media. And here I am on the media. It's very, very ironic, actually. So enjoy the rest of your week and weekend, and we'll talk to you next week. Stay tuned to the Northbound Wealth Podcast every week or every couple of weeks. As necessary, I'll provide updates and we'll have a nice conversation. All right, take care and cheers. Thanks.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.